Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Hello, James.
Hello, Jim. How are you?
I'm doing good. Welcome to another episode of Enlightened Wealth Strategies.
Yes, very good.
Today we have a special guest.
We do. We have a great guest. I know this gentleman for a number of years going back, and we reconnected recently. He is a CPA, but he's not doing that work, and we're not allowed to ask any tax questions.
No problem with that.
Because that's not the work he's doing anymore.
That's okay.
So this actually will be more directed to small business owners and mid-sized business owners as well. But he provides a unique service.
Okay.
And I think we're going to learn a little bit about what it is he does, how he does it. But it's an outsourcing of his expertise in the form of the financial issues that small businesses usually face. And most business owners are pretty good at what they're doing, whatever that particular product or service that they provide may be. But sometimes they may not be so good in, the financial management of the company, which unfortunately sometimes happens. Or they may not be able to afford to have somebody on a full-time salary to provide, the financial controls and, the financial management, as I said before, of the company itself. And this is where he might step in and to help them out with this.
Well, why don't we give an introduction then?
Yes. So we have Ben Mills with us. He is a CPA. And welcome, Ben.
Thank you. Thanks, James. Thanks for having me on today. I'm excited to be here.
Yeah. So Ben, tell us a little bit about, we do know each other for some many years, as I mentioned before, but you recently left the accounting world and moved over and started your own little practice, but it's not really in the tax realm any longer of tax accounting. But, maybe tell us a little bit about, what your reasoning was for leaving, and now what you're doing at your new group. That's called Cardigan Consulting, correct?
Correct. So I launched Cardigan Consulting last year. I was after being in public accounting for approximately 25 years. I was a partner for about 17 of those. And I saw a growing need in the small to mid-sized businesses that they weren't being utilized, and that's the financial aspect and helping them with their businesses. I'm a licensed CPA in New York and New Jersey. I also teach at a university up in the Hudson Valley. But I launched Cardigan Consulting, which is a fractional CFO consulting firm working with small and mid-sized businesses throughout the country, primarily in the tri-state Northeast area, and helping them with their finances. What that is in a nutshell is I try to bring financial clarity to the financial numbers so the business owners can make more informed and better decisions in running their business.
Okay, that's great. Now, Ben, what is fractional CFO? What does that mean exactly?
So basically, I can provide the high-level financial strategy and decision-making on a part-time or fractional basis, so the business owner doesn't incur the full-time cost of a CFO. So
interesting.
I might work with them one day a month, one day a week, on whatever their goals and whatever they're trying to accomplish.
So you're an outsourced expert to the
Yes.
to the business owner. Okay.
Yes. And they can get a higher level consulting, financial guidance, confidant, someone to talk to because I find a lot of the small, medium-sized business owners, they often don't have people to talk to about ideas they have on where they want to take the business, what they want to do, where they want to go with it. And I find a lot of them just need the resources to bounce those types of ideas off of.
Now, you say small to mid-sized businesses. So could you frame what, the revenue stream, the annual revenues?
Typically, it's around 4 to 5 million, up to probably around $40 to $50 million.
Okay.
In revenue. Sometimes I do some work with startups that are taking off, whether they be in the technology area or different things like that. But typically, the average business is around 4 to 5 million to about $40 to $50 million in revenue.
So that's a fairly large range. And do you have any specific businesses, industries, or?
Well, coming from public accounting, I've worked with a wide variety of industries, but the ones that I'm sort of more focused on or I do more work with would be like the construction, distribution, and manufacturing area, and some startups as well, and some service industries. Those are probably the primary industries that I work with and I do work with now.
But you're not exempt from working with any other industry. I mean, numbers are numbers. Doesn't matter.
Yeah, I mean, a lot of business owners like to think their business is super unique, but they all, often come down to the same common denominators. Most businesses do anyways.
We have, or I should say, I deal with a lot of business owners. And one of the things that I've been trying to do is help our business clients move forward. From my perspective, I've always done like group benefits and 401ks, and then we get into buy-sell agreements and stuff like that when we're dealing with a little bit larger with companies. Are you addressing all those needs as you sit with potential relationships?
Absolutely. That's the first thing that I do with any new client would be what I call an onboarding process, where it sits down and gets an idea of where they want to go and what they're doing with the business, what their long-term plans are, what their short-term plans are, what their challenges are, and things like that. And then we build a strategic plan back into it. So depending on what they're doing, those could all be part of the discussions, absolutely, depending on where they are in their business and what stages and where they want to go.
Now, I guess for the purpose of tracking do you do like a business valuation to see where they are at the moment so that you can show them as you're progressing along, how they're starting to grow to enhance their aspects of things?
What I do is it's not an official valuation. What I do is I take a snapshot and we look at their finances, where they are today and where they want to be 2 years, 3 years, 5 years down the road. I mean, as you guys know, a business owner that wants to sell their business can't wake up on a Friday and sell the business Monday. At least true. Not if they want to get top dollar and the best advantage. So a lot of that is just the plan of what they're doing, a real assessment, a real honest discussion of where they are today.
Yeah,
the good and the bad.
So to that point, Ben, when you and I were talking not too long ago, we were discussing people who sell their business, and it's let's take a little bit of the conversation we had and just take it another step forward. It isn't uncommon that a lot of the business owners do want to sell their business. Whether it's I don't think they want to sell it over the weekend, but perhaps a year or 2 or 3 down the road. So let's say, for example, they think their business is worth $10 million, but you assess it for maybe a little less than that, but they're not accounting for the taxes that they're going to encounter. I know that we promised we wouldn't talk about taxes necessarily, but that's an important component of helping them with this ultimate sale of their business. So to Jim's point, that's either a business succession plan, which it really is, whether they're going to sell that directly to outside buyers, or they're going to do something else, maybe somebody that's within the company or family. Doesn't really matter. They're looking to sell their business. and they think it's worth $10 million, and they think, oh, I'm going to get $8 million and then retire in the Mediterranean or the Caribbean. And we know that's not realistic. So do you have to help them to better assess where they're at, to get them to a better, maybe their business is not worth 10 million today, but perhaps with your guidance, they might get this business up to 12 or 14 million dollars, a higher valuation. Again, taking it to the point that Jim pointed out earlier.
Yes, I mean, absolutely. That's part of the discussion. And I don't want to mislead you. Taxes are a very important part of running the companies. And it's often discussion. It's often something I deal with on a daily basis. And I partner up with the accounting firm that the client, the business owner has or uses. And definitely part of the discussion is if we want to sell the business in the next year, 2 years, 3 years, getting an idea of what we're going to sell it for. And then what are some tax minimizing strategies we can implement today or start implementing to minimize the taxes? And it's tough because I've had cases where the business owners call me in after the fact when they're on the cusp of selling the business and they want to implement all these strategies, and it's kind of late to do that. So anytime a business owner is starting to think about selling their business, transitioning their business, whether it be to their kids, to an outside third party, one major component of those discussions is the tax consequences, and it's often overlooked. Because there's very big differences between selling assets or selling stock or selling things like that on how they can be treated and options that are available for you. The other area that business owners often forget about when they sell the business, to your example, they sell it for $10 million. They think they're going to fly off into the sunset with $10 million, but they often forget that they might have to pay off all the debt that they have still on their books with that $10 million. And they often end up with a lot less.
So you're giving them a reality check.
Yeah, because they get overwhelmed by, as I'm sure you both have seen, they get overwhelmed by the gross number that they see, and they quickly assume that that's what they're going to walk away into the sunset with, and it's often not the case. When you take into the other components of the transaction. So that's all part of the analysis that we would do. The different options, the different tax consequences, and how much they would really walk away with. And sometimes they have a number that they want, and then you have to work the other way to see if we can figure out how to get them a higher value, so they ultimately end up with the number that they're hoping to retire with.
So so now you're also so there's several components to this. You're looking at the day-to-day operations. So this company might have, might increase their sales, or they might not have their account receivables might not be, the collection ratio might be not so good, and you could assist them in improving that amongst many other areas of the financial aspects of the business itself. That helps to improve it. That helps to make it a better business, a viable franchise, perhaps to purchase, to get interest from other third-party buyers. But the other issue that I wanted to bring up too was you mentioned that it could be an asset sale, could be a stock sale. That the entity, the type of entity that they have, whether it's a C Corp or an S Corp or a partnership, you deal with that as well, because there could be different consequences on the sale, the taxes, how long the sale might be for, whether it's an installment sale. So there's a whole host of other issues too. Is that correct?
There could be a wide variety of different issues. You're exactly right, depending on the ownership. And sometimes I see in transactions, there could be earnouts. There could be payments down the line, depending on how the company does after you leave. There could be built-in contingencies in the transaction. There could be, sometimes the deal might be more valuable, but you get less money up front, but you could end up with more money 2 or 3 years, but that's contingent on performances. So there's a wide spectrum, a lot of different options when you're selling the business that I try to put together so you can make the best decision for yourself. I mean, every business owner has different needs and wants and ideas of how they want to structure the deal. So there's not always a best case scenario or the right answer. It's often dependent on the seller and the owner of the business. And that can vary.
Fascinating.
But one of my goals is to present it in a way so they can make an informed decision. And that starts with what are your ultimate goals? Where do you want to be? And it's generational stuff and children, etc.
Now, we got onto the subject of selling a business, but I guess realistically, you hope to help them grow the businesses too. So let's step back for a second, and let's say their future goal is to sell the business, we'll say 15 years in the future. How do you help them grow scalably wise? I mean, what is it that I'm assuming, and I don't like to assume, but I'm assuming you're taking a look at all the financials, and then you're from there trying to put into perspective what can help them grow the business. Am I correct on that?
Yeah. So the biggest difference that I do now than you would think of your traditional accountant or your controller in the company, they spend their time focused on what you did yesterday, what you did last week, last month, last year. And I spend more of my time trying to help you figure out tomorrow, next month, next year. So what I do is we'll build a 12 to 18 month forecast of your business, sort of tailored to where you're trying to go, whether that be grow your revenue, grow your profit. But what the key is when you're doing that is to make sure your expenses don't grow at the same rate. Make sure you're scaling the business. Look for opportunities to save money, look for improving processes. To Jim's point earlier, a lot of businesses might grow the revenue, but then their collections suffer dramatically and their accounts receivable increase a lot. And so what we have to do is if we're going to grow our revenue, we have to have good internal processes on how we invoice, how quickly we collect the money, because there's an often misperception with a lot of business owners, the difference between revenue and cash flow. I wouldn't say don't try to grow your business, but businesses struggle and go out of business, not because of revenue, but because of cash flow. So one of the vital aspects that we do is not just a forecast for the business, but cash flow, cash management forecast as well. Because once you cannot make payroll, once you can't pay your rent, your vendors, your whole business can come to a screeching halt pretty quick.
In a way, Ben, it's not dramatically different than what we're doing on a personal financial planning level for individuals.
Exactly.
Yeah.
Exactly.
Quite fascinating. So then that brings me to my next question. What do you think are in my head, I kind of have an idea what are some of the largest expenses, but besides payroll, what other expenses do you see that a business owner encounters as their major expense that you try to help them solve or reduce?
I would take a step back and say that would completely depend on the type of business that they're in and what product and or service they provide.
I like you. That was a good answer.
What's that?
I like you. That was a good answer. That was a loaded question.
But I'll tell you what I typically do, because business owners are very busy and they're usually very talented, whatever product they sell or service they provide. And so I don't want to sit there and show them an Excel spreadsheet with 1,000 different numbers and things like that. So what I try to do with a lot of business owners is build a dashboard. And what I mean by a dashboard is 4 or 5 things that are driving the business that we got to look at every month. And if they're not trending the right way or they're going the wrong way, they're red flags for us that we need to look deeper and take action. And the drivers that I typically see often is your cash balances, your revenue, your gross margin, and your net margin or net profit. And those are the things that I'm looking at every month. I'm going to show it with the business owner every month. And if any one of those 4 items starts to go in the wrong direction, we dig deeper and we look to what's going on and why it's happening. Now, for what I do, I'll look at a lot more numbers than that, and I'll get more under the hood. But for most business owners, they're very busy people and they need to stay focused on what they're doing. So I think just having a dashboard that they can get their hands around helps them tremendously.
Is this something like a software program that you've acquired that would help them with that visualization?
Depending on the business and depending on the owner, it'll depend on how it gets presented to them. Some business owners know finances really, really well, so you might dig a little deeper. Some not so much, so you might stay at a higher level. And it often sometimes depends on what software program they're using internally, because the last thing I want to do is recreate the wheel and increase costs and generate the reports. So you find the middle ground to get the information that you need without incurring a lot of costs.
So you have to do a lot of customization then. Is that correct, Ben?
Actually, because a lot of companies are on QuickBooks. A lot of the small, medium-sized business are on QuickBooks. So a lot of it, you can set up programs where they extract the data and they can generate a lot of the reports fairly quickly, and accurately. The two challenges that a lot of business owners don't get is, A, they don't get their financial information timely, or they get it timely, but it's not accurate. And I try to streamline that. I can't tell you how many business owners I speak to who really don't know how they're doing until the fourth quarter when their accountant comes in to come up with the fourth quarter estimate. And that's when they find out, oh, I had a good year or I had a bad year. The problem with that is by November, the year is almost over. So if you find out that your margins are decreased, or your revenues decreasing, or your net profits there's not a lot you can do. You're at the end of the year. You got a month left.
Exactly.
And what I'm trying to do is get this information to maybe in May or June, and then every month. So if gross margin is decreasing or not going the way we expect it to go, we are proactively making changes on the fly to make corrections.
Okay, you kind of took away a little bit of the next question I did want to ask is what were the major obstacles or challenges that some of these small to mid-sized businesses encounter. So you described that. So the second prong of my question would be working with other advisors that the small business owners have. And as you pointed out, you have the CPA. Being a CPA, you've done this before. It's now just you moved into a different realm, so to speak. So what are the other advisors that you would also coordinate with that the business owners have already engaged?
It could be their legal counsel. It could be their financial advisors that I would work with, because sometimes from a cash flow standpoint, their biggest component of whatever strategic plan we're trying to implement. So I would bring in a lot of those different advisors. It could be their attorney, their accountant, their financial advisors like you, James. And it's important that we're all on the same page, that we're all going in the same direction, and we're all in agreement with it. And the owner's the goal at the end of the day is, what's the owner ultimate goal of where you'd like to go, what do you like to accomplish, and trying to just bring everybody together so we're on the same page.
Yeah, so you become part of the team, and
Yes.
you're more or less the coordinator now at this point.
Yes.
Okay.
Because I'm inside the company a lot more than a lot. And I was in public accounting. Accountants aren't there that often. They're there to do the tax return. They're there to do some estimates, but they're not there more on a day-to-day, week-to-week, month-to-month basis.
Right. So in essence, there's some similarities, parallels, that we're doing this on a personal basis, and you're doing it on a business level, and we're looking at things on a prospective basis rather than retrospective, which, the accountants, the CPAs are generally doing that because they have to do tax returns, as you mentioned. So it's compliance oriented, and sometimes they're not doing, the planning, the month to month planning. So yeah, at the end of the year, they're caught and they go, oh my goodness, I didn't do so well. Or some of them might find out in March or April when they're filing tax returns. And there's really, as you said before, there's not much you could do at that point in time. So you are helping them not only to improve their business long term, but you're improving it on a short-term basis as well. And they are being able, as you stated much earlier in our conversation, they have this information. And so now they can make an informed decision about any other aspects of the business and how it might be improved, or how it's operating, or if there's going to be less surprises, I suppose. And that's really what you're helping them to do.
Right. It's like, and to your point, it's like coordinating with their outside accountants. They had a good year, but maybe a lot of their revenue's tied up in their receivables right now, so they don't actually have the cash, but they have a big cash obligation due with the return or with the estimate. Or they did collect the money, but no one's coordinating the tax aspect, so they forget about it, or they don't put money aside for taxes. And then you want to avoid a big surprise come March 15th or April 15th if there's a big balance due, because nobody's planning, nobody's taking everything together in one big picture. And you see that unfortunately often.
And we encounter that on the personal level too.
Exactly. I'm sure you do.
Clients hate the fact that they are surprised. I owe this much in taxes. And I learned many years.
That never happens though, does it, James?
No, never happens. But that's one of the things that I espouse to do, because I learned, interestingly enough, going back 100 years ago when I was when I started in public accounting, I worked in the financial planning group, which was an arm of the tax planning group or the tax department. And I had both perspectives. Yes, we did things on a retrospective basis for those individuals for tax compliance purposes. But when we did the financial planning, we did tax planning projections as well. So there weren't any surprises. We weren't allowed to do that. So we're applying the same principle for the individual and the business owner.
Exactly.
Ben, one of the things that I've encountered, and I was just curious as to how you address it, because I like collaboration. I know that I don't know everything. So then you have to bring in the experts to handle it. When a owner of a business asks you to be part of the team, have you faced or had any issues with overcoming egos? Like with the other attorneys, CPAs, financial advisors?
Yeah, are you stepping on their turf?
Well, I've been fortunate that I haven't, because I've been able to explain to them that I'm not a threat. I'm not looking to do what you're doing. If I wanted to still do tax work, I would have stayed as a partner in the firm I was with and continued to do that. So I try to make it more like I'm not a threat to the services you provide. If anything, we complement each other, and we're just trying to help the client. But it's at the same time, you stay in the areas that your expertise is in, and you take the guidance from other people, other people's expertise. And if I'll give you an example, and this has happened. If a financial advisor suggests something that I don't understand, I have no problem calling them offline and just bringing clarity to the matter and getting an understanding of what they were thinking. Because, one thing I've also learned is not everybody knows everything that goes into every decision or background. So it's trying to bring everybody up to the same place.
Excellent.
Ben, what is the best advice that you provide to business owner or business owners, assuming that it's a partnership, which I'm sure you deal with as well, where they feel overwhelmed with all the financial data? I'm sure that's a multi-pronged response too, but just out of curiosity, what do you encounter and how do you handle that?
Well, it can be very overwhelming, especially when there's surprises or things might not be going as well as they've gone in the past. And what I try to do is just calm everybody down, explain, get a handle of the current situation, and then work with them on a game plan, a realistic game plan that can be implemented going forward. And by calming them down is try to explain to them what the situation is and what things mean, and what's the difference between cash and just pure revenue, and explain to them that they're not alone, and explain to them that by developing a plan and taking action, we can get out of it. A lot of the times I find business owners don't want to take the time or invest in their strategic plan, and they just hope that if I can grow revenue or something, it'll go away. And my experience is it doesn't go away. And that by setting up a plan, people can rally around and get around. It often calms them down. It helps them relax a little bit, and then they can get back focused on their business and their product.
Excellent.
Now, going back, Ben, to the business succession aspect of these small businesses, and the reason why I bring that up is not necessarily the fact that at some point in time they may sell the business, but just business succession issues. Do you deal with those? Jim mentioned earlier in our conversation about buy-sell agreements. Do you encounter that? And if so, how do you address that for these business owners? Because I'm sure you're dealing with partnerships, you're dealing with families, you might be dealing with single owners. So there's some, I'm sure there's some landmines that you're encountering along the way too.
Yeah, I mean, the quick answer is yes, I deal with that. It's a nature of working with small business owners. And then the family issues always bring another level of dynamics into any of the discussions, because as you guys know, often with a lot of these business owners, there's conflicts that go way beyond just the business, and their family dynamics that you have to work with. And the other thing that I've done a number of times, is sometimes the father or the mother, the owner of the business, wants to start thinking about handing it down to the next generation. And sometimes I find myself explaining the financial side of the business to the next generation. What cash flow is, what gross margin is, what the importance of collecting the receivables as quickly as possible is. So sometimes it's just explaining the financial side to the next generation. But as far as selling the business succession planning, absolutely, that is a component of what I do. And it all starts going back to what I said earlier with the onboarding, and that's the initial discussion of getting a realistic picture of where we are today and what is their plan. Is their plan to someday give it to the children, give it to the grandchildren? Or is it that they don't really have family members that are interested in running the business? So is the plan to sell it to an outside, unrelated third party? And getting that down so we know where we're going. And sometimes the answer to that is, I don't know if I'm going to sell it to my kids. I don't know if they want it. I don't know if they could handle it. But these are all discussions that occur over time.
One of the things
because for most business owners, the business is their largest asset by far.
One of the things that I've encountered, like I got a small business that I handled their group benefits and 401k plan for. And the father is getting ready he's pretty much let the son running the business. Do you find that it becomes, for the purpose of estate planning, he has a situation where he has another son who wants no part of the business whatsoever? And one of the things the business is the bulk of his asset, the value there. And I guess my question to you is, in this particular case, he's trying to come up with a fair way of allowing the one son so that the one son can continue running the business, but yet making the distribution fair upon his eventual death for both sons. And right now, even though the one son's taking over the business and running it, there's that fear of, if dad's not around anymore, will the business stay in business?
Yeah, but that is a common occurrence where where the owner has one or two or three kids, and for whatever reason, one or two of the kids aren't interested in the business. So that happens all the time. And we try to figure out a way to compensate the kids that don't want to be involved in the business if you wanted to be fair with the estate. I've seen sometimes where if the business owns buildings or assets, maybe the kids the kids that don't want to be involved become owner of the hard assets like a building, and they collect rent, whereas the other first child might get the business. Sometimes there's assets outside of the company that's used to make it more even, but it's a constant struggle whenever you have family dynamics, because often the disagreements or the issues go way beyond just the core business. They go into family issues over generations.
So one of your other hats, Ben, is that you are also a psychologist.
I think I would say you guys probably are doing the same thing as well.
We are. But that's why I had to say that. So.
Yes, I think that's a challenge that you have, especially if you work with the company for decades or for a long time, and you've seen the kids grow up, and you've seen them, come back into the business full time. Those are some of the challenges you deal with. Absolutely.
Yeah. The family dynamics.
Yes.
And
that's why most businesses don't get to third, fourth generation.
No. Because there's clashes between family members. And as you just described, some don't want to be involved, others do, and the ones that don't want to be part of the business, they still want to be remunerated accordingly, just like the other ones that are in the business. It's like, wait a minute, you're not fair. Part of the business anymore. So,
or the brother doesn't work as hard as the sister, and the sister wants to, stuff like that, or vice versa, and you get into all those types of things.
Exactly. So, so you're also dealing with another member of the team, is the insurance people. Whether it's the personal or the business or both, if they have one of each.
Yes.
So you have a lot of professionals to deal with, aside from the business owner and his employees. So that leads me to another question. Do you have to, at any point in time, work directly with some of the employees?
I typically will work mostly with the senior management of the company, whoever that is, in their different departments. I don't often work with different levels below the senior management.
Okay.
But a lot of the issues that we're dealing with or addressing can affect the whole company. Perfect example, like you just said, insurance, whether it be health insurance or business insurance. So it can relate to everybody, but normally I'm working with the senior team, the department heads, stuff like that.
Yeah, the reason why I bring that up is a lot of our focus and attention in our discussion has been around the income, the revenue that's being generated from the business. But the other piece of it is, as we both know, when we're as accountants, there's income and expenses, there's assets and liabilities. So I'm sure you're spending time with them addressing some of the corporate or company expenses as well as the liabilities, because that helps to improve the bottom line if you can manage those two pieces.
Absolutely. So when we're looking at the expenses, to your point, whether it be labor, direct labor, or indirect labor, besides just comparing to what they've done in the past, I also benchmark it to their competitors, to the industry, to see how they shake out. Because you're exactly right. If you can grow your revenue all you want, but if you're not scaling the business and watching your expenses, you can end up working harder and making less money.
So is that what that means by financial scaling?
Yes, that's what I mean by some financial scaling. You're scaling the business as the business is growing, or if revenue is declining, scaling the business appropriately to your revenue and to where you're at. I have seen, I don't know, I would say often, but I have seen where businesses might grow at 15, 20% clip, their revenue, but then their general administrative expenses are also growing at 15, 20%. And you look down and your revenue grew 20% and your net income is basically flat. So you're basically working harder, taking on more risk, and you're not making any more money.
Right. So now
Sometimes it's explaining to the business owners where they actually make their money, what customers are profitable, what regions are profitable. All too often they have an idea of what it is, but it's not always 100% accurate.
It's fascinating. I'm going to give you an example. I worked for a big financial institution, and they trained, and I say big, but they trained their employees to manage expenses right down to ordering pencils.
Right.
And they trained them to do that, but with also at the end of the year that their bonuses would be better and they would also get more in their 401k plans. And so I don't know if you help to point out to the management team, hey.
Well, I can give you a perfect example of that. So I had a client where we implemented a purchasing order process, PO process.
Mm-hmm.
They never had one. So people had to complete purchase orders before they went to buy things. And the process is working. And so someone might spend $200 at a store to buy something. And I would tell them to call the people on occasion and, compliment them if they got a good price, or let them know you're looking at it and you saw that they purchased something for $200 or $300 or $500. Because when people know you're looking at the stuff, they're more likely to be a little bit more diligent. Even just compliment them that they're following the policy and they got a good deal on it. That way they know you're looking at it. You don't always have to call them when there's a problem.
That's interesting. That's an interesting approach. And you would think that I'm sure most businesses are not doing that or having their employees perform that little task.
I'm not saying all the time, just once in a while, calling them, hey, James, I noticed you went to AutoZone or Lowe's and you spent $500 on whatever. Were they on sale? Because that looks like a good price. You're not trying to play gotcha. It's more just putting in their mind that you're looking at things and you're tracking the expenses and they're being monitored. So the next time they're aware of it, you know what I mean?
Yeah. No, that's a great approach. Jim, anything?
Off the top of my head, no, but let me ask you this question. When we're dealing with business owners, I find that I come across a lot of times where one hand doesn't know what the other hand's doing. And it sounds to me like you're the ideal person to bring in so that they can get a grasp of that. I try to help my clients as much as I can, and I find that a lot of times, even with what I give them, they don't always follow my instructions. Can't understand why. But if I gave a referral, and I'm assuming you work with other advisors, is that correct?
Yeah, I work with all different professionals, absolutely.
So if I gave a referral to you, is your business at this point capable of handling an influx of new potential candidates?
Yes, absolutely. I also have a lot of resources that I utilize as well to support the business. But to your point, I often act as the quarterback for a lot of the different departments within a company. And the owners use me as someone that can just bring together an action plan and hold departments accountable. And they feel that if we have a meeting and they know they're coming to the meeting and they committed to do X, Y, and Z, someone's holding them accountable. And often business owners just don't have the time to put that level of detail. I worked with a company over the winter where we were implementing a job costing program, and we had regular team meetings with all the heads of the different departments, and they all would leave the meeting with an action plan, knowing that the next meeting they're going to be called to the table on did they complete the action plan, and if not, why, and what resources they need, or what can we do to implement it. I don't want to say I was the bad guy, but I'm the one that's holding people accountable, and the owner can just stay focused on what he's doing.
And so you're playing bad cop and he's playing good cop.
Yeah, because I've heard him say, "You better come to the meeting, or Ben's not going to be happy."
But that's good too, because he is able to stay in his lane more or less, and he's giving you, and he's telling them, I've given him the ability to basically tell you what you need to do.
Yeah, and it's freeing him up to focus on what he does really well and what they do. I should say what the business owner does really well to grow the business, to keep it going. So it just shares some of the responsibilities, so they don't feel they got everything on their shoulders. Because a lot of business owners, especially in small, medium-sized business, the biggest thing they can often feel is just alone. And what I mean by that is they don't have someone they can confide in. You know, you don't want to go to your senior management team if you're thinking of selling the business, because then they're going to be worried, do they need to look for another job?
Right.
So sometimes they just want somebody that they can confide in, and it could be a good idea or a bad idea, but they just want to talk to somebody about it. You know what I mean? And that's something I do often. I'll get phone calls where they're, hey, I was driving to work and I had an idea. Am I crazy, or can I talk to you about it? You know, and what are your initial thoughts? You know, and sometimes as you just talk it through, the answer to the question, comes to light. But sometimes it's not a bad idea. Maybe we should look a little deeper into it. But at least they have someone to talk to.
Well, these business owners have given you authority, so their employees know this, and he's also now anointed you his confidant as well.
Yeah, so that's a lot of that. One of the hats that I wear, absolutely.
Yeah. So
they get that, and that's going back to the original question at the beginning of this. They get it on a fractional basis, so they don't incur all the costs of hiring a full-time CFO.
Exactly. All right,
so we can get a lot of that without hiring it.
All right, I want to shift gears and go back to the business valuation, because you and I, we did have a conversation. We each have clients that are in the process of selling their businesses, and I mentioned before we're not going to talk about taxes, but the taxes are the big issue when a business owner does sell their business. They're going to encounter taxes. So I have someone who's selling, and it's probably going to be a big capital gain. Their concern, of course, is they don't want to pay taxes. So we have to come up with some income tax strategies to minimize the tax impact wherever possible. Not an easy task, as you know, Ben. So firstly, you need to get a business valuation, I would think. And then thereafter, now you know what the price tag is. You now know with third parties what they're willing to pay, at least in a range. And then now you can calculate what the results are going to be, and then you can get a better sense of the tax consequences. Thereafter, do you help them and assist them with minimizing the overall tax impact so that they are able to take more proceeds and perhaps go off into the sunset or spend time in an island in the Caribbean more often?
Yeah, so absolutely. I mean, we joked about not talking a lot about taxes, but obviously taxes are a big component, whether you're selling a business or just running your business day to day. So to your point, you get a valuation, you get a ballpark idea, or you get an idea of what people are willing to pay for the business. And then I speak to their financial advisor, or speak to their accountant, and we work together on a strategy to minimize the taxes, where they are now and what we could do going forward to minimize it, or how to allocate it, or how to defer it, or how to, just different options. And I find that there's no technical right answer, because every business owner might have slightly different ideas of their goals and what they want to do. But you come up with a plan. And then as a team, all their financial advisors work together to implement the plan. But I'd want everybody on board so there's no surprises. The last thing I try to, and I don't want to have happen, is you come up with a plan and you get to the finish line, and then somebody comes up with something because nobody ever asked them.
Yes.
Or nobody ever consulted with them, or something out of the blue just comes out. So I want it all up front to the best we can. These deals seem to change on the fly sometimes anyways at the last hour. but I want to try to minimize it with what we can control and what we can do ahead of time.
And could you be more specific about any of the planning techniques that you put together to minimize the overall tax impact?
Well, some of it would start with how you're going to sell the business. Some of it could be, is there going to be an installment sale, maybe delay some of the payments. Some of it could be how you allocate the proceeds to different assets, stuff like that. So there's a lot of different things, whether you set up a trust. A lot of the business owners would be generally better to sell their stock, but a lot of the buyers don't want to buy stock. They want to buy the assets.
Right.
Because there's advantages to both sides of those. So that's all part of the negotiations on how you do it. But every deal seems to be slightly different, and every owner has different goals of how they want to get the money out of the business.
Just a quick question in regards to the assets. Like, to me, health benefits, payroll, 401k plans, they're all part of helping the employees. And when you sit with the plan or the owner of the companies, do you hash out how to look at those? The 401k can be an asset, but the cost of like the group benefits, and how do you then go back to the advisors who are handling those plans to say, okay, I think there's something better out there, without insulting them or causing a conflict between the owners and the advisors? So,
well, what I typically would do in those situations is I would talk to the business owners about what you had just said, but I'd be also talking to the advisors on maybe why they set it up the way they did, what their thoughts are or their ideas on why it works and why that's the best idea, and try to see if we can work with them to figure out a solution that might be more in line with the company. I mean, sometimes plans get implemented and then 15 years goes by and that plan maybe was good when it was set up, but maybe should be reviewed and altered going forward because the owner's goals have changed. So I try to make it more collaborative as opposed to me saying, hey, you should be doing this. Why aren't you doing this? It's more on a team basis, because I often find you guys set things up based on a goal or a plan that was structured maybe many years ago, and things have changed.
Yeah.
And maybe it's time to review it and as collectively as a team come up with a better solution.
Right.
I don't think I would call them up and say, that was dumb. Why did you do it that way?
No, I agree with you on that. I find a lot of times though that things get just running and no change takes place. Nobody's reviewing it. Nobody's going through it. Right. I can say personally, I mean, even with myself, the plans that I have, I'll sit with a plan sponsor and I'll explain to them that there are other ways of handling this and it could theoretically save you some money. But I don't think anybody dives into it the way I dive into things.
Right.
I try to always look at it from the standpoint of doing right for not only the business owner, but also for their employees. Because if they're happy, things are more productive, things gets better all the way around.
Right. No, I 100% agree. And I think you guys would agree that the world's changing so fast in a lot of these things, and new tools, new services, new products are always coming out. So it's vital that you're continually looking at these. A perfect example with health insurance, a growing trend for small and medium-sized businesses is self-insurance type plans.
Yes.
For health insurance.
Yeah.
And that would have been taboo maybe 10 years ago, or that would have been nuts to think about 10 years ago. Well, it's becoming much more of a viable option for the right company. But it's something that should be looked at.
Yes.
And whether you implement it today or you keep it, I have a client now, we were looking at it and we agree that maybe now is not the right time, but it's something that should stay on the radar for maybe 2 to 3 years from now.
So Ben, we're coming up on the hour. So perhaps you could give us 3 major highlights that you would want us to be aware of, and our listeners as well, and other advisors who will certainly be listening in on this, and small business owners, of course, themselves, that may want to utilize your services.
Well, I appreciate that. And again, I wanted to thank you guys for having me on today. I guess a couple of things that I want to drive home to a lot of business owners is the importance of cash management and the importance of your cash flow and strategically forecasting it. And the importance of just overall strategically planning your finances. And it doesn't have to become an all-inclusive, takes up every hour of every day, but it should be on your radar. And then an example someone gave me not that long ago is a lot of business owners will quickly spend $40,000, $50,000, $60,000 on a new piece of equipment or maybe technology. But an investment in their financial strategic planning could yield far more profit, improve cash flow, accomplishing your goals. And they're a lot more skeptical about doing that. And I can't stress enough that whether it's me or a different fractional CFO or your accountant, getting transparency to your number, getting more clarity on your number, will help you make better informed decisions going forward with wherever you want to take your business.
Okay, that's great.
Yep.
Well, Ben, we want to thank you for being a guest today. We'll speak again, I'm sure, in the near future, and perhaps before the end of the year, we'll have you back, and we can have a deeper.
I very much appreciate it.
Yes, you're very welcome. All right, Ben.
Been a pleasure, Ben. Take care.
Take care. Nice to meet you, Jim.
Bye-bye.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy, engage in any financial transaction, and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only, as of the date of the production or writing, and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bell Point Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.